If you walked into your bank today and tried to withdraw every dollar you have, they couldn't give it to you because the system was never built to hold your money the way you imagine. So, where is the money? If it's not in a vault, what is it? People think a bank is a giant vault. You deposit cash, they store it, you withdraw it later. When you deposit money, the bank records it and folds it into its everyday funds. Those funds sit in a shared pool the bank puts to work. That's the core business. Banks lend. Here's what's really happening. Banks keep only a fraction of deposits available as cash or instant reserves, because if they held everyone's money untouched, they couldn't make loans, couldn't earn interest, and the modern bank wouldn't exist. So most of the time the system works because not everyone asks for everything at once. Your money is available as long as the crowd stays calm. This is why bank runs are so dangerous, because the system can't handle panic. A bank run is simple. Too many people try to take their money out at the same time. The bank can't pay everyone instantly, because much of that money is already out as loans, so fear spreads even faster. And when fear hits, people don't pull out cash, they pull out trust. And trust is what keeps the whole machine running. So, where is your money? Some of it is held as reserves and liquid assets. A lot of it has been turned into loans, mortgages, car loans, business credit. And some of it flows through short-term markets designed to keep banks liquid day to day. Meaning, your deposit is not sitting still. It's moving through a system that depends on timing. That's why banks love one thing more than money itself: predictable behavior. Steady deposits, steady withdrawals, no surprises, because surprises are expensive. To be clear, this isn't a scam. This is a design, a trade. We trade perfect safety for a system that can finance homes, businesses, and growth. And to reduce the risk of collapse, modern finance builds guardrails: deposit insurance, capital requirements, central bank backstops. Not to make banks nice, but to stop fear from becoming a chain reaction. So the real takeaway is this: bank balances are entries in a ledger, your claim on the banking system. That system holds together when trust holds together. When trust wobbles, everything around the numbers starts to wobble too. So your money rests on confidence in the system and the promises behind it. A relationship, a contract. And if trust cracks, your money becomes what it really is: a promise.